Hey everybody, welcome to another episode of The Remote Real Estate Investor. I'm Michael Albom, and today I have with me a very special guest, Paul Moore. You may have heard of him from Bigger Pockets, you may know him as the founder and managing partner of Wellings Capital, or you might know him better for his fight against human trafficking. And today Paul's going to be talking to us about some pretty hot topics, specifically with regard to inflation, commercial real estate, and also what Paul and his team are doing to fight human trafficking. So without further ado, let's get into it. Paul Moore, welcome to the show. Thanks so much for spending the time.
It's great to be here, Michael. Thanks for having me on.
No, of course. So before we started recording here, I was learning a little bit about your background, but for all of our listeners who might not be familiar with you, would love to learn a little bit more about kind of who you are, where you came from, and how you're involved in real estate today.
Yeah, absolutely. Let's see. So in the mid 80s, I got an engineering degree, which was my first mistake. And then I went on and got an MBA, went to Ford Motor Company, spent 5 years there. I actually really liked Ford, but I had a desire to be an entrepreneur. So I quit, started my own company. I ended up being a finalist for Entrepreneur of the Year in Michigan a couple of times. And we sold that company to a public firm in 97. Came to Virginia, started flipping houses. Then I started flipping waterfront lots. Then I built some modular and stick-built homes. And I learned something. You shouldn't build a house if you don't know how to tighten the doorknob on your own house. I don't know, just something I learned. Just thought I'd tell people that. And,
Word
and
for the wise.
Yeah, right. So, but that's one of the values of working with a company like Roofstock. If you're flipping houses or building houses yourself, you might have a full-time job or something else. You might not know what you're doing. And it's great to be partnering with somebody who does. That's just a side little advertisement for you guys. But anyway.
Appreciate the shout out.
Yeah. But over the years, I was wondering how to get involved in commercial real estate, but I didn't know how. And so I actually started a website to generate residential leads for buyer's agents. And actually, I had like 40,000 people on our list at one time that had come through our lead gen and sold those to realtors that I'm still getting, leads all the time. I got that running in the background. But at the same time, I started a multifamily and / hotel, and we built it, I should say, in North Dakota. Then we did another one next door. My business partner did a hotel. I jumped back into multifamily syndication, and now I do self-storage and mobile home parks as well. We're on our fourth fund with my company right now.
That's awesome. And what is the name of your company if folks want to get involved in that space?
Yeah, it's Wellings Capital. Awesome.
Is that wellingscapital.com is the website that people can go to?
Yeah, that's right. Mm-hmm.
There's so much I want to unpack here, Paul, and it sounds like we'll have to have you on for another episode, but I'm just curious, getting back to your engineering degree, what kind was it? And I know you said it was a mistake, but do you think that there was any value in terms of being mathematically inclined or numbers inclined with that degree to helping you in real estate?
Michael, I'm glad you asked that. No one's ever asked me that, but I think it really is true because like I said, I went on to get an MBA, and some things that were really simple to me, like, calculating, weighted averages and things. Other people were just like, what? So yeah. So yeah, I think it did. I think the discipline of getting an engineering degree did help. I got a petroleum engineering degree. And it was funny, when I went in 1982, there were 7 graduates coming out of that program, and they had 7 job offers each, and oil prices were high, And wow. When I got out 4 years later in 1986, there were 89 graduates, and they had 7 job offers total. And, the oil prices were up and down. And, I should have learned right then. Getting a degree in something like that is quite speculative. It's not like industrial engineering or other things that have a steady demand. It was kind of like swinging for the fences, even back when I was 18 and I joined that program. And Michael, when I sold my company in 97 and started investing and doing other things full time, I should have learned the lesson, but I had to learn it all over again. And that's the difference between investing and speculating. Speculating is when your principal is not at all safe and you've got a chance to make a return. And investing is when your principal is fairly secure and you have a chance to make a return. And over time, investors win over speculators almost every time.
Yeah, I'd agree with you, but I think it's such a sad story that we hear so many of these big stories about the speculators hitting it big, Bitcoin, billionaires all overnight. But what you don't hear is the
Yep.
other 100,000 people that lost it all in that same speculation.
It's exactly right. And that's, again, I think that's what your company and our company are both about. And that is, investing, and expecting a stability and an expectation that's not based on a war in the Middle East or a rumor or a tweet from Elon Musk.
Yeah.
I mean, we're talking about the value of roof stocks and our real estate didn't go up or down when Elon Musk tweeted because it's based on real math
Right.
and real foundational stuff,
Yep. No, I love it. So kind of speaking about speculation, we were chatting before the episode and talking about a topic that I think is really, really relevant to today that I want to dive deeper on, and that's inflation. And so talk to us a little bit about, in your estimation, why you think real estate is such a great hedge against inflation. Because I think so many investors hear it all the time. Oh, it's a great hedge against inflation. But unless you really understand why, I think it becomes so much more impactful to really get the reasoning behind it.
Yeah, I didn't understand it myself till I really dug in when this inflation started heating up. This is some $10 trillion bills. These are real from Zimbabwe, and and there's other ones back here from Venezuela, and inflation is real. I don't think that the United States will, in the short term at least, experience any kind of hyperinflation like that. But we obviously have real inflation. I mean, I think I read that in June, the consumer price index, which doesn't even cover everything, was up 0.9% in that 1 month. And it's up like 5.8% for the year.
Wow.
And if you included all the stuff they used to have in there, I think it would be much higher. Cantillon, I believe it was Richard Cantillon, was a famous economist about 300 or 400 years ago. And he had something that was called the Cantillon Effect. He basically said that those closest to the printing of the money stand to gain or lose most from that printing. And if you think about who's, the two most powerful forces in the world are the Federal Reserve, and I don't mean just the US, but any Federal Reserve, and the government. And you've got a chance here by investing in real estate to align yourselves, even if you don't like those guys, the government and Federal Reserve, you've got a chance to align yourself with them by investing in real estate. Now, here's how specifically. You can look back 5,000 years, and I'm serious. They did a study on this, and interest rates are the lowest they've been in 5,000 years. Yes, you can go back to ancient Egypt. Just Google it. And it's, there's some semi-credible, I'm kidding, there's some credible sources on there showing that they've studied this back for thousands of years. But even if it was just the last 100 years, what a powerful moment in time to have interest rates this low. My son recently got his first house, and he's a young guy, and he got like a 2.65 or 2.7% interest rate. We just closed on a large mobile home park with a 3.0% interest rate with many years of interest only. I mean, it's powerful. But think about this. If you can get your largest expense locked in for years or even decades at a very low interest rate, and then watch the revenue climb due to inflation. In other words, the rents are going to go up right in line with inflation. And actually, with the housing shortage right now in America, they're going up higher than inflation. I mean, there's reports of lots of places where houses went up 20 and even 30% last year. I know one place that went up 60. And so we've got rents that are going up way higher than inflation. But even if they stay with inflation, imagine the increase in rents with your largest cost being fixed for either 10 years, 12 years in commercial, or 30 years in residential. It's a powerful dynamic, and the ability, the delta, the difference between that increasing revenue and that fixed largest cost is your increasing cash flow and then increasing equity you have in this property. And importantly for me, we talked about speculation. Also, as that gap widens, you're increasing your margin of safety in case anything goes wrong. So it's three powerful reasons that inflation is a great time to invest in real estate. When there's inflation, it's a great time to invest in real estate. But when there's low interest rate debt, it's even better. I remember the late 70s and early 80s when, inflation was in the mid or high teens, but so were interest rates. Now we've got a very different situation. We've got increasing inflation, but low interest rates. Very, very amazing time to invest in real estate. Take action, folks. Now's the time.
Yeah, I love that. Just the visual of your arm saying, okay, here's your revenue, but your costs and your expenses stay fixed. And so just for everybody listening that might not even be familiar with the term inflation or really what it means, at its base level, it's the value of the dollar tomorrow is less than the dollar today. So if milk costs $1 today, tomorrow it costs $1.03. It costs more money to buy those same goods and services. And so if you're not investing in something that generates a higher return or that keeps up with inflation, your dollar gets left in the dust. And so a lot of people talk about putting their money in their mattress or leaving it in a bank. And you can actually lose money in a sense because the value decreases with time.
Yeah, it's true. And I told somebody the other day who got a 2.9% mortgage or something. They were a really young guy. It wasn't my son, it was somebody else. And I said, do yourself a favor. Don't ever pay that off. And he gave me the look, like I said, don't pay extra. Don't try to pay it off early. And he gave me that look because I think he'd studied Dave Ramsey. And
Debt-free is the way to be.
Yeah. So Robert Kiyosaki said this well, because I've for years gone, okay, Dave Ramsey's right, but he's not right. And Kiyosaki said it well. We were in Belize together with the real estate guys about a month ago. And he said, I'm friends with Dave Ramsey, and he's right. For the vast majority of people, they should pay off their credit cards and their bad debt. But there's also a good kind of debt, and that's the debt against an asset that's increasing in value, like real estate. And so that's where Dave Ramsey's thinking would get you wrong. He'd say, don't have debt or pay it off quickly and all that stuff. Getting fixed rate debt for a long, long time in real estate is a fabulous move. And it's a way that people have got extremely wealthy for many years. Sam Zell said it was one of the keys to his wealth. And he is the most successful real estate investor in America, possibly in the world. And Sam Zell said that's one of the ways he got wealthy, by getting low for him, 6.5% to 7.5% interest debt in the 70s and having an increasing inflation against that. Yeah.
No, I think it makes so much sense. And once again, people can start to wrap their head around that delta and how that delta works over time, 99% in their favor. It starts to become blatantly obvious that, hey, this is a really great place to park money.
Right. It's so true. It's so powerful. And even as I talk about it again, I just want to jump off this podcast and go buy something else,
Yeah. And something that we talk a lot about in the Roofstock Academy is running the numbers and really getting a grasp upon, okay, well, how are my dollars working for me? What does the return look like? And just at a very high level, I mean, if you're borrowing money at 3% and earning a 5-6% return on those dollars, you've just created a spread out of thin air. Yeah. And, you've created an arbitrage, and that's what banks do. They lend money out at certain, and then they borrow it at a different rate, and the spread is where they make their money. We're doing the exact same thing.
Mm-hmm. That's right. And the wealthiest people in the world understand this. And, banks, whether they're loaning money at 3.5% or 13.5% or whatever, it doesn't matter as long as they've got that, couple point spread, that arbitrage is where where the profit is.
Love it. So, Paul, let's change gears here a little bit. Since I know that you're a multifamily guy, I'm a total multifamily guy as well. Talk to me about how you made that transition from single family into commercial multifamily, or how you've seen others do it really well. Because I think for a lot of people, it's this whole new landscape. It's a whole new world. Oh, commercial mortgages. I could never do that.
Yeah.
What have you seen successful people do?
Yeah, so my mentor had about 110, I think it was single family homes around Cincinnati and other places. And he realized, wow, what if I could buy a 110 unit apartment building would that be more efficient? And he started drilling down and studying that and realized, one loan, one big parking lot to scrape snow off of, one
roof,
one set of roofs to repair. Yeah. And so he thought it was a really good idea to go into commercial. And so he did that, and he found, that he ended up selling his single family homes at that point. And a lot of people have made this transition, though you don't have to. I mean, there's companies, out there that have hundreds or thousands of single family homes, and they're doing well also. But at any rate, the difference really is that one of the big differences I want to point out is this. In the residential realm, your value is based generally on comps. So if I bought a house for $200,000 and I added like $300,000 in improvements, I put in gold-plated fixtures and a big expensive fence, and I built out the attic and the basement, made an addition, and I had $500,000 in it, but I was in a $350,000 neighborhood. It would be hard to sell it for a profit, if I had $500 in it. In commercial real estate, the value is based on math, and that math is quite simple. It's kind of similar to the PE ratio, price to earnings ratio in stocks. The math is this: the value or the value increase is based on the net operating income, or the NOI increase, divided by the cap rate, or the rate of return. And so let's go over that. So the value, the price, is based on the income stream. And so it's the gross revenues minus the operating expenses. That'll give you the net operating income. That's the numerator. The denominator is the rate of return. So if you're looking for an 8 or 10% return, you divide by 8 or 10%. Now, it's really hard to get deals like that anymore, but cap rates these days are typically 4, 5, 6%. So people are tolerating, if you will, a 5% return. And so here's the math on that. If you have $100,000 a year net operating income, not including the mortgage and not including any depreciation, but if you have $100,000 NOI and you're willing to tolerate a 5% rate of return, that's a 5% cap rate, 100,000 divided by 0.05, that'll give you a $2 million value. In other words, you'll have to pay $2 million to get a $100,000 annual cash flow stream. And so if you are the seller, you can think about ways that you could force appreciation. Let me see. If I'm a self-storage facility, I could add, I could take some of this unpaved grass out here on the side, this 3 acres, and create, RV and boats parking and create additional cash flow. If I'm a mobile home park, I could put in, like we literally saw a guy, we invested with him. He put in a 1 acre fenced paved area and added boat and RV parking to a mobile home park, added $10,000 a month. And let's do the math on that. Okay, this is crazy. So let's say it was a $5 million mobile home park, $3 million in debt, 60% LTV, $2 million in equity. So he had $2 million in cash in it. We were one of the investors in this, okay? Now, he added a $100,000 paved, fenced parking area, and he said to all the people who had 3 or 4 or 5 or 6 cars sitting in front of their trailer, you have to park it out here, and you can't park your work trailer and your boat and your RV in your yard anymore. So they cleaned up the place, which allowed them to increase rents, by the way, but they also charged people, and they were making a total of $10,000 after a while, renting these slots out in this paved area out front to the people in the park and the community. $10,000 a month. That's $120,000 a year. $120,000 divided by a 6% cap rate. In other words, $120,000 divided by 0.06. If I'm not mistaken, that's about a $2 million increase in value. Wait a minute. There it is. $2 million. They only had $2 million in equity in this. So they just doubled the equity. In other words, the investors got 100% return on their money by this one simple change. Now, my friends, that's called forcing appreciation. It's a very, very powerful thing that commercial real estate has. And so if sometimes you can raise rents by 10%, but with leverage, like I just showed you, you can increase the value of the equity by maybe 30%. Or you can add additional empty lots, to a mobile home park. Or like I said, parking to a self-storage facility, or you can increase occupancy by 10%. There's so many ways you can force appreciation. So buying from a mom and pop seller, let's say of a mobile home park that, the owner doesn't have the desire or the knowledge or the resources to increase value, buying from them and paying them what in their mind would be a huge price, and then making these improvements can really juice the returns for investors.
Yeah, that's something that I realized a while back when I first got involved with multifamily, is that you're limited on the single family space to comps. If your neighbor's house doesn't take care of the neighbor doesn't take care of their house, that affects you. But in multifamily and commercial, if you're able to create, because essentially you're buying a business, you're buying and selling businesses. And so that's why it's valued based upon the cash flow. So if you can create and creative ways to generate additional cash flow, that has a lot of value. And in that example, I love that $100,000 investment yields $2 million in value. And the cool thing about that I think I want to harken back to is that they don't have to sell that to realize any of that $2 million in value. You can go do a cash out refinance. You can establish a business line of credit and tap into that. So it's usable, tangible dollars that you can access for doing the work. So I love that example.
Yeah, you're making me think about a self-storage facility in Colorado Springs. By doing something like that, they were able to just refinance and return all the equity to investors. Now the investors have no risk left on the table. There's nothing they can really lose because they got their principal back, and now everything is pure profit from then on.
That's awesome. That's awesome. So if we scale it down a little bit to smaller multifamily, still commercial, so 5 units and plus, where do you see people really succeed in making that leap between single family to commercial multifamily? And then by that same token, where do you see people get burned?
I think one way, and I'm not sure this will perfectly answer the question, Michael, but one way that it works really well is if you see intrinsic value. And here's what I mean. Michelangelo, the greatest sculptor ever, said, "I saw the angel inside the block of marble. All I had to do is chisel and chisel till the angel came out." And that sounds silly, but it's really, really powerful because basically he was able to identify intrinsic value, meaning he didn't see it as a $300 block of marble. He saw it as an extremely valuable sculpture, and he was able to pull that sculpture out. And so a great operator can see value where there is not any. In other words, the extrinsic value, the sale price is, let's say, $1 million, but he can see a possibility of increasing that to, say, $1.5 million by doing something creative. And so I'm thinking back to your question now about the 5 units. If you can find land where maybe there's an extra acre there, but nobody seemed to have noticed that, and you can go get permits, to add 5 more units, that is where a lot of value can be created. One time I bought a 5-acre parcel of waterfront property that was absolutely not subdividable, but I actually found a way to legally subdivide it into 5 1-acre lots. There's obviously that was a huge, huge win. I'm thinking of, I have a friend. Now this is a little different, but this is kind of cool. He had his clients. He's a large realtor in Minnesota. He was having his clients buy these, I thought, overpriced large single-family homes near campus. And I was in the car with him once, and he was on the speakerphone, and he was telling this guy to go ahead and pay $400,000 for this single-family home that rents for $1,600 a month. And I said, that didn't sound like such a good deal, Eric. And he smiled. He said, "It's near campus. All we have to do is furnish it, put 2 beds in each room. We can rent it for like $600 a bed." And it's the math on that, like he'll make his gross revenue will be over $4,000 a month on, a property that he paid $400,000 for. Now that is a smart way of extracting intrinsic value out of a single family home.
That's great. That's great. I love that. I'm in the midst of a redevelopment project myself. It was a 3-unit residential with, I think, 4 units commercial, 3 stories, 20,000 square foot building. And I was realizing that the area was starting to pop, and you could even see it just coming down the street, the transition and changes that were coming. And so I'm making it into 15 residential units and 2 commercial units. So I talk a lot about it on the podcast in prior episodes about some of the brain damage and lessons learned. But once it's done, I'd be very excited.
Oh, you sure will, especially in these times. And adding inflation on top of that.
Yes. And I think just one of the pieces of intrinsic value that people can keep an eye out for, and it's something I talk about all the time when chatting with newer investors and in the academy, is look for under market rents. And I think that's so counterintuitive. But if you can find an asset that's priced upon today's rent, but you know that it's undervalued, all you have to do is buy it, increase the rents, and now the investment should be returning even more than you bought it for.
Yeah, it's absolutely true. You just reminded me, our fund is considering investing with a multifamily operator that does a couple things. He goes in to a municipality and he actually negotiates. He'll find an asset that's like $200 under market rents. Then he'll go negotiate with the municipality and get a huge tax abatement. And so he'll go in, then he'll be able to raise the rents by, let's say, 200 over, say, 2 years. You don't want to do it day one necessarily. But if you can take your taxes, which is probably most of the time your second largest expense behind the mortgage payment, out of the equation, he's able to get like an 80% tax abatement sometimes in these opportunity zones or whatever.
Oh my gosh.
It's a massive win for investors.
Wow. That's incredible. So yeah, I think just to wrap this up with a bow, look for opportunity where other people might have overlooked. And
exactly.
I think
that's the way to do it.
Yeah. I think too that there's this semi-vicious cycle on properties. If someone sees it and passes on the opportunity for whatever their reasoning might be, then it sits a little bit longer on the market. Another person might come take a look at it, not see an opportunity, sits a little bit longer. And so by the time you get a look at it, it might have been on the market 30, 60, 90 days, whatever. And so you think, there must be something wrong with it. And so that's the reason you pass on it versus people might just not be looking at it through the right lens. Yeah. And so I think give every property, give every opportunity a shot and try to look at it through a really objective lens.
Yeah, it's really true. My son buys land that way, and there's guys who, there are like land is a very risky thing to invest in. I'm talking about large land tracts, in the mountains, but there's like 7 uses for land now. I mean, you can do solar, you can do cell towers, you can do timber, you can do carbon recapture and sell those credits to companies. I mean, there's all kinds of things. You can rent to farmers. You can, in the Blue Ridge Mountains where I am, you can rent to hunters. I mean, there's so much you can do with one piece of land that might have been overlooked by hundreds of people for years.
That's incredible. Yeah. So remove the box and the opportunities become limitless.
Yeah, right.
So Paul, I know that you're a pretty big advocate and involved in the fight against human trafficking. Would love to learn a little bit more about that.
Michael, you wouldn't believe this, man. You can take the record profits, not the average, the record profits of Apple, General Motors, Nike, and Starbucks. Add those together, triple that number, and that's less than the annual revenues generated by human trafficking right now. It is a huge problem. I'd like to believe if I was alive in the 1800s, I'd have been like with William Wilberforce fighting to stop slavery. Or I'd like to believe if I was an adult in the 1960s, I would have been fighting for civil rights. Well, this is a civil right. It is slavery, and it's happening right under our noses. So my company, Wellings Capital, is putting together a program where everybody who invests with us, we are attempting to free a slave for every new investor that comes in. And then we're going to give those investors access and opportunities to help that person, get back on their feet, et cetera. So we're doing this through organizations we're vetting. I mean, as a company, we vet real estate opportunities, but as a company, we're also now, and as individuals, we're trying to also vet the very most effective organizations who are getting this work done. And really excited about being part of this.
Wow, that's really exciting. That's really, really exciting. And thank you for the work that you do. I mean, that's really incredible stuff. And so where can people learn more about how to combat the issue other than, of course, investing with your company? What are some things and steps that people can take action on to help combat the issue?
Great question. So the first step I would take is I would go on YouTube or anywhere else online and find the movie Nefarious. Nefarious does a great job explaining the problem, laying it out there, demonstrating, from videos around the world, from Las Vegas to Thailand, what is really happening. Exodus was put out by an organization that I highly recommend people check out. It's called Exodus Cry, and that's exoduscry.com. And you should be able to go there and learn all you need to get started in fighting this.
Fantastic. Well, thank you for that. That's fantastic.
You bet.
And so to kind of wrap things up here, I know that you've written several books and are quite an accomplished speaker, and you're involved with Bigger Pockets. Would love if you could share the titles of your books with everybody listening.
Okay, great. I wrote a book on residential real estate in 2008. That's more localized here for Virginia, but I wrote a book called a very humble title about multifamily. I don't know what you think, but it's called The Perfect Investment. And we found out that the perfect investment isn't necessarily perfect if it's overpriced. And so be careful of that title. Watch out for that guy. And then my new book coming out from Bigger Pockets Publishing in October is going to be called Storing Up Profits: How to Capitalize on America's Obsession with Stuff by Investing in Self-Storage.
Amazing. Oh, I love it. This seems to be an asset class that's been getting a lot of attention in the last couple of years.
It really is. Self-storage and mobile home parks they're sort of like on the heels of multifamily for getting maybe too much attention. But this book is attempts to just lay it out for a beginner or for somebody who wants to invest in it remotely.
Okay, that you took the words right out of my mouth. I was going to ask, are these books great for beginners who are looking to learn about the asset class and about how they might be able to invest in it?
Yeah, both of the books are designed for people who want, it's as a beginning primer for somebody who wants to get into the asset class, but they also double as an opportunity for somebody who wants to find a great operator and invest with them. It's kind of giving a baseline of knowledge to know where and how to invest.
Awesome. Well, Paul, this was great, man. I so appreciate you coming on and taking the time to hang out with us. Any final thoughts for investors that are just getting started and primarily in the single family space?
Yeah, I would, so when I heard about single family investing, it was 2000, and I was kind of in this weird time. We had started a nonprofit organization here in Virginia, and we were trying to figure out next steps. And my friend and I said, you know what? We've learned a little bit about this, read a little bit, read some books, done this and that. We need to go take action. And so what we did is on December 20th, 2000, we went to our first home auction on the courthouse steps of Martinsville, Virginia. There was snow, there was ice, and we didn't take any money because we said, you know what? We're just not ready yet. We're not ready to jump in. We've got to just be careful. And so we went with no money at all. Well, we went and comped the house first, and we came to the conclusion it was worth $65,000. It looked like it was in perfect shape. We peeked in the windows of the vacant house. It didn't look like it needed anything that we could see. And so we went to the auction. We said, of course, we didn't know what we were talking about, but we thought, man, if this comes out at anywhere like 50,000 or below, it'd be amazing. Well, it came out at like $33,000, and there was nobody else bidding on it. We didn't have any money, so we couldn't take action. Well, we were able to talk the auctioneer into going to Taco Bell for lunch while we ran to the bank and got a cashier's check. And we actually bought that house, and we had to give them, like $3,400 down, which was about 10% down. And literally, Michael, 3 weeks later in January, we put it back on the market and had a for sale by owner sign in the yard Monday at 8:30 a.m. And we had a full price buyer for $65,000 by noon, and we were off to the races. So I'd say this, if you've been studying this a while, if you're just looking around, kicking the tires, take action, jump in, get involved because there's literally never been a better time that I know of to capture this incredible delta between inflation and low interest rates.
Love that. A better time may have been 6,000 years ago prior to that study, but a second to that, I think the best time is
That's
now.
right. Good point.
Awesome. Well, Paul, thank you again for coming on. Really appreciate you sharing all your knowledge and wisdom with folks. Really appreciate you combating the fight against human trafficking, both really noble causes. And we look forward to, I'm sure we'll chat with you again.
All right. Thanks, Michael.
Alrighty, everybody. That was our episode. A big thank you to Paul. It was a lot of fun. Learned a lot. We talked about some really great issues facing kind of humanity as a whole, as well as real estate specifically. And we definitely look forward to having him on for future episodes. As always, if you like the episode, please feel free to leave us a rating or review wherever it is listening to your podcast. If you're checking us out on YouTube, hit the like and subscribe button at the bottom of your screen. And we look forward to seeing you on the next one. Happy investing.